Good morning. Thank you for joining us. Exactly 6 weeks ago, the headline was interest rates will remain high. The sell off in the global bond market was excruciating. The war had no, in a sense, clarity as to which way things would move, and central bankers were nervous about inflation. The world has changed in 6 weeks. A lot has changed. Are you delighted? Are you surprised? Are you happy?
I'm all three of those things, yes. And to me, it was the CPI inflation reading for the month of October that came out on Thursday that was the catalyst. And it shows you that for the fourth consecutive month, headline inflation is down, but more importantly, it looks like core inflation is also rolling over. And some of the core readings that the Fed looks at closely, like the TRIM mean CPI and the median CPI that the Cleveland Federal Reserve run, those data series, they actually fell quite sharply on a month-on-month basis. So the world has changed, and I think it is because we're finally seeing what we knew all along. We knew all along that many readings we were getting in the durable goods sectors and the commodity sector and in the services sector were showing us that inflation was coming down, but now it's finally starting to show up as a trend in the actual CPI inflation reading.
What are the chances that the financial markets are running ahead of themselves? Because it would take perhaps 2 or 3 months of back-to-back data which will only support the thesis that CPI has topped out, which means in the interim, Fed will not declare a victory against inflation. So what happens in the interim, where the street would be divided on what could be the next course for the inflation print and also the Fed commentary?
I don't think we need the Federal Reserve to declare victory to be able to say that we can feel better about markets. By the time the Fed declares victory, the markets will be substantially higher than we are now. I mean, it depends. You were asking if the market is overbought. Well, it depends on your time horizon. It's probably overbought just in the very short term. But one thing I'll say is that the S&P was up 5.5% on Thursday. That was the day the CPI number was reported. And there have only been 24 other days since 1950 when that index rose 5% or more in one day. Now, if we look 3 months out, 9 out of those 23 other times, the market was actually down. But if we look 12 months out, in only 2 out of the 23 was it down. And so I feel that 9 months out, I'm actually 3 months out, I'm still pretty confident we're going to be higher. But I'm just saying, if you look back historically, the odds aren't very strongly in your favor. But certainly 12 months out, the odds are strongly in your favor. And we've had a very strange year this year in that both stocks and bonds have fallen more than 10%. That never actually happened before. It's also a year that follows another year, 2021, when bonds were down. So bonds will be down for 2 years in a row. And actually, bonds are something you can go back to the 18th century and look at. Believe it or not, the data does go back that far. Never before did you have 3 years in a row when treasuries were down. So I think I say with quite a great deal of confidence that we put in a bottom a month ago for the stock market. Bonds, if they haven't peaked now, are very close to peaking, the yield, I should say. And next year is going to be a good year.
So next year is going to be a good year, 2023. The US dollar index, let's not forget that as well, 112 levels retreating to near 106. Mark Matthews, what I would love to get your views on also is what the kind of announcements we're now seeing from China. how it is now trying to revive the property market, the kind of commentary that's come in. We did see commodity prices overnight also go up since those news out of China. How is that going to impact flows?
Well, so the China news is very significant, and there were rumors going around starting also about a month ago, actually, that they would be lifting the COVID policies. And they're not lifting them, they're just loosening them. But what we hear anecdotally from my colleagues here who have friends and family in China tell me that just anecdotally, there's lots of evidence in the cities that they live in that these policies are no longer being adhered to so tightly. In many cases, they're not being adhered. I mean, one thing, for example, is that you might know they'd set up all these little tents across the cities across China where people had to go in and get a COVID test once every 2 days, once every 3 days, in order for your phone to have the green code on it. Well, most of those tents are now shut. So that just is anecdotal evidence right there. And then the property is also material. Now, I don't think property will come back in a big way, but because the sentiment is still very depressed, and I think that they needed to send a message to people: just stop buying property. We don't want you buying all these units and keeping them empty. It's not healthy for the economy. Anyway, the fact that they've done both is a positive, and I think marks an important inflection point and bottom in the Chinese market as well. And it is an incredibly cheap market. I mean, I can tell you that one old axiom among value investors: if you can ever find a company whose price earnings ratio numerically is below its dividend yield, then just close your eyes and buy it, because that's wrong. Usually a PE ratio should be 15 times, the dividend yield should be 3%. Well, I can list a dozen off the top of my head, very large companies in China, banks, petrochemicals, telecoms, etc., where the PE ratio is 4, 5, 6 times, and the dividend yield is 8, 9, 10, upwards of 10%. So this is an important change. What it means for flows, I think, is that there will be less interest on a relative basis in India because China is coming back on a lot of people's radar screen.
So the outperformance that we have gotten used to, the decoupling, if you can also call it that, being one of the best stock markets on the planet, are you saying that may not be the case going forward in 2023?
Yes, I believe that China will outperform India in 2023 because, they moved in completely opposite directions over the last couple of years. India's up, I guess, about 20% over the last 2 years, if at a minimum, must be more actually. And China is down by something like 30%, probably more. So that can't continue forever. It doesn't mean we don't like India anymore, far from it. But I do think next year that India's will not be an outperformer because the other markets that have done so poorly will come back. And not just China, but you've got Korea, you've got Japan, where the yen is down something like 30% from where it was at the beginning of 2021. Of course, big losses in currencies in Europe and Britain as well that make those markets look attractive. And if the dollar truly has peaked, then I would expect interest in them on a relative basis. Therefore, people will be no longer as interested in the places that have done very well.
Good morning. What is your outlook when it comes to India, in particular with respect to the liquidity situation, given the fact that we are seeing that reopen in China, as we just flagged off, as well as what's happening with some of the other emerging markets like Brazil? What is your outlook as to how you're seeing the overall FII position for India?
There are two primary sorts of FIIs. There's the global fund managers, and there's the emerging market fund managers. So, as the names imply, global fund managers invest around the world. Emerging market investors just invest in emerging market. Between those two pools of money, the one that is much bigger is the global fund managers. And I think that they are underallocated in India. And with the dollar peaking, they'll be looking for emerging markets to invest in. And they will probably put some money in emerging markets. But the emerging market fund managers, I suspect, will be moving their funds from India to China, Korea, other very beaten up emerging markets. How those balance out, I think probably they neutralize each other, actually. So I wouldn't be that concerned about the FIIs. On the one hand, you'll have the emerging market fund managers trying to find deep value in other places that look like they've bottomed out. But on the other hand, you'll have those global fund managers putting new money in.
You know, the two things, Mark, which really stood out this morning was Warren Buffett's latest buy, which is a Taiwanese chip-making company. And also Druckenmiller. I mean, the fact that he's bought stake in Amazon now in the third quarter, his other additions do include even the Meta platforms. Are you intrigued as much by the same?
Yes. Actually, you're telling me news I didn't know, to be honest. I was busy this morning, okay. So I hadn't seen that. Well, what to say? I think it is quite interesting to see the NASDAQ putting in some firm technical support, which it is, and the outperformance of growth since that CPI number came out has been very stark. So I think what's happening is, I can't speak for Druckenmiller or Buffett, but what's happening is that people have lost so much money this year. They want to make some money into the end of the year. They can feel a year-end rally coming. They're buying the things that have gone down the most. Now, specifically about Amazon and TSMC, I presume you're referring to. I can't really comment on those individual companies or why those two fund managers bought them. But I would say one last thing, which is I'm very encouraged that despite the cryptocurrency fallout, NASDAQ and technology is holding its own very well. Because if you recall in June, which was the last big sell-off we had in the technology sector, the correlation of cryptos and NASDAQ was almost 1. It was 0.9%. This time they're moving in very opposite directions. So I think that's an important thing to highlight, the change in the sentiment.
Thanks much for joining in.